Today, I've got 5 Canadian stocks for you that I think are undervalued, that offer an interesting opportunity to beat the market, and the best part is they're all in the Canadian oil and gas space. The storyline we've been developing over the last couple of months here that we think offers a huge potential thanks to assets being mispriced, companies not being fully understood, and investors' aversion to the space. And we think taking advantage of that as an individual investor right now gives us an opportunity to outpace the market over the short, medium, and long term. And that's what we're going to be doing today. So let's start with our first stock of the list here today, CNQ, Canadian Natural Resources. Now, these guys are my biggest position personally in the Canadian oil and gas space, and I think they're probably my highest conviction play for a couple key reasons. Now, first off is their size. These guys are the biggest player in Canadian oil and gas. They're also the largest Canadian oil sands player, which I personally think offers one of the best long-term returns. But their size also gives them a couple key advantages, such as synergies, lower operating costs, the ability to outlast any sort of dip in the price of oil, which is key right now. And it means they're not likely to be acquired by a potential competitor or some international company coming in to try to vulture the space. That means that these guys are likely to not be the cheapest on the list today, that you're not going to see the more sort of dramatic volatility that you might in some of the smaller players, but they do give me a better sleep well at night experience as an investor. And that means I have a little bit more confidence building a little bit bigger of a position in these guys than I might with a smaller player. Now, I talked about oil sands and I talked about the fact that that's my real thesis here, but it also comes a little bit from my thesis on shale oil. Now, I'm hardly alone in this thesis. So many investors are in on this, but basically the story of shale oil is twilight and then decline, which means the production growth has basically stalled out. The geology there is just not looking the same way that it did 10 years ago, right? They're running out low on these tier 1 oil wells. They're running low on the ability to drill more of them. The price of oil is dropping right now, which means the break-even cost on tier 2 is just not viable. So basically production has stopped growing and we expect to see it start to decline over the next little bit. Lots and lots of institutional investors are with me on this one. So hardly an individual thesis, hardly a unique story here. And this is hardly a unique pick in the Canadian oil space, but it does make me feel comfortable and confident building a huge position. That's why I'm buying more of it right now. Now, if I jump over to the fiscal.ai screen for CNQ, I'll show you a couple of key stats on here. Now, I mentioned they're the largest company in the space. We're talking a 95 billion Canadian dollar market cap. That puts them at a price to earnings ratio of 11.6. Now, while that might not be the best way to value a company like this, it is a way that we can value all of these. I can show you sort of the relative valuations of these different companies. They have some pretty great financials. We're not going to dive too much into things. Their debt to equity looks really good. For example, their cash position is good and their dividend is awesome. We're talking 5.7% dividend and we're talking a 70% payout ratio. So they're in a space where their dividend is comfortably covered by their current cash flows and they claim they can sustain this down to a $40, $45 barrel of oil. Even at the lows we've seen this year, they've been in the mid to high 50s. So you've got a significant cushion on the price of oil on that commodity risk that you're taking buying a company like this. And it puts you in a position where you're going to win more or less no matter what. You're going to get that shareholder return no matter what. 5.7% is nothing to sneeze at. A lot of investors would be happy just taking that. So having the ability for this company to materially grow in the long term as their assets become re-rated, as shale oil starts to decline and these long reserve life assets start to become much more valuable and put themselves in a much better position being here in Canada with less competition. I just see upside for these guys. They're a longer term hold in my opinion. I don't think you're necessarily going to see a giant jump in price this year or in 2026 necessarily. But I think once we get through this sort of short-term decline and these short-term challenges, their long-term story is awesome. So I'm accumulating as many shares as I can at these prices. And honestly, I hope the price goes lower because in the short term, if it does go lower, that just means more for me. The second stock on the list today is Tourmaline Oil. Now, these guys are my natural gas player. And again, this should not surprise anybody. These guys are the scale player, the largest producer of Canadian natural gas. And the thesis here behind them is basically my thesis around natural gas that I've talked about a couple times. Basically, price of natural gas is way too low. It does not make sense. And it's because of a couple of really short-term weather events, seasonal events, maintenance events that have all lined up at the same time to knock the price specifically of AECO, Canadian natural gas, way lower than it should go, and the overall price of North American natural gas way lower this year than we're expecting for the next year and years after that. That means that I have the opportunity right now to buy these shares at an incredibly low natural gas price, which has dragged the price of the stock way down. In fact, the whole year basically has been tough on Tourmaline specifically because they also this year announced a whole bunch of capital expenditures that they're going to be doing to grow their production and basically grow the company. Thing is, if you're announcing a bunch of capital expenditures into a time period where your profitability is looking rougher and rougher, and the natural gas price that your company depends on is looking rougher and rougher, investors get mad because investors are so short-sighted. My story here is basically you get to buy these shares at pennies on the dollar right now at a super cheap natural gas price. And you get to buy into the biggest player in the space that has a huge amount of inventory that can just go at a time when we've got AI data centers demanding natural gas. We've got LNG buildup demanding natural gas. We've got all of this opportunity in the medium and honestly, even in the short term, like over the next couple of weeks, natural gas prices are going to increase because we're getting into winter, because we got all this maintenance that's getting done in the Canadian basins. So we're going to have this natural gas price increase in the short term. And then it's going to be just boosted by, LNG, AI. The stories are just bullish. These guys are entering a massive commodity boom for natural gas. That's going to have a material change to how much profitability this company generates and to how sustainable that profitability is. And then you're going to see investors love the stock again. Thing is that investors, again, were so short-sighted that they took the short-term downside in 2025 to mean that they should sell their shares at a loss instead of seeing the opportunity in 26, buying shares now and making a huge profit. When you look at a couple of the key stats for Tourmaline, they also have a couple of advantages that are specific to them. Now, the first, of course, is scale. These guys are a $24 billion market cap company. And again, like CNQ, that puts them in the position of somebody who's acquiring assets and much less likely to be acquired by outsiders. Now, at 25, it's not impossible for these guys to get bought out, right? They don't have that same cushion that almost $100 billion company like CNQ would have, but they do have the ability to buy smaller assets, which we saw over this year. Now, as far as PE goes, they're trading at a 15 PE. The future targets, the next 12 month targets, a little bit lower. But remember, part of that story is going to be the dropping natural gas price. So the company's going to look more expensive on a short-term basis. Well, I think if you look at a 2-year out PE, these guys are probably trading under 10. So remember that when you're looking at some of these valuation metrics. And again, PE is not the best way to value a commodities company like this. Now, dividend yield is something special because these guys pay out a 6% dividend as it shows here. But a big story with these guys is their special dividend. And while they do pay out consistent dividends that are not bad at all, the special dividend is where these guys absolutely shine. Thing is, in the future, I think that story could even be morphed a little bit because I think as we see more and more consistent natural gas demand, they could offer you a more reliable, consistent, regular dividend. And that story would attract so many investors and would, again, boost the stock price. These guys are a more short-term play for me. And while I'm not talking about a 6-month play, I don't swing trade. That's not what I do. I'm an investor, so I'm looking at least a year out. I think the real profitability to be made in a company like Tourmaline is within 2026. I think your opportunity to buy it at these prices is probably not here for long. I don't think you're going to be able to buy shares so cheap all throughout the rest of this winter. I think as we see natural gas prices increase, shares will increase proportionally. And then as we see the story get better and better and better and the profitability get better and better quarter over quarter, then these guys are off to the races. And you could see the stock double or triple within a couple of years, which is just insane to think about. But again, it is just in such an awesome position and is at such a low stock price that it doesn't make sense. Third stock on the list today is ARC Resources. Now, these guys share a lot of similarities with Tourmaline, but they are not the exact same. Now, ARC Resources is also a great natural gas player. They're a little bit smaller and they're a little bit cheaper, which makes them a very interesting and compelling buy for me right now. But they also offer some interesting growth. And that's a story that we haven't seen a lot of in the Canadian oil and gas space, people trying to grow the companies beyond just acquiring things. So to show you guys ARC a little bit, I do want to show you a couple of their assets because I think there's a couple of key things that make this company make a little bit more sense for me. Now, the first story that we do need to talk about is the fact they acquired a bunch of cacao assets from Strathcona Resources when Strathcona opened their bid for MEG this spring. Now, at the time, seemed like a great idea. We were expecting the price of natural gas to jump from LNG Canada. We're going to have this, a couple billion cubic feet a day demand just like constantly there. It was going to change the game. Didn't happen. Didn't happen this spring because we basically had all these sort of short-term challenges. Didn't happen this summer because the summer was a lot cooler than people had expected, right? Inventories had built up. Summer didn't have that demand. It didn't happen in the fall because all of a sudden there's a bunch of maintenance being done within the basin. So it's going to happen in the winter and it's going to happen next year. And that's going to have a huge boost. These guys are so cheap right now that it doesn't make sense. They've been in the last couple of days underneath 10 PE. Again, not the best way to value a company like this, but just to show you the contrast there, right? They're basically half of the pricing of a larger player like CNQ, and even they're significantly underpriced compared to Tourmaline. So the pricing story here makes a lot of sense to me. And they've been growing projects like the Atashi project, which means that they have the ability to continue to grow their cash flows, to grow the company, to grow their revenues, to grow their dividend, to grow everything in the long run, despite the price of natural gas not going anywhere. So even in a world where natural gas isn't doing anything, ARC Resources is an interesting growing company. And I think that's huge because, again, a lot of these other stocks I'm taking are plays on the commodity itself. These guys are just plays on the company, on the growth, and on the management. And I think it's a huge story. If I show you a couple of the key metrics here, again, we're looking at a $15 billion company, so smaller again, but they got a PE of just 10 right now. And again, like I said, in the past, week or two, they've seen that PE fluctuate even into the single digits. Their forward PE next 12 months is underneath 10, 9.3. And if you look at that 5-year revenue growth chart, which is sort of a more fair one than looking at the 2022 comps, it's like 40% revenue growth. Their EPS is growing pretty fast, right? Like high single digits EPS growth on a commodity company. Hello, I'm into that. And the dividend is awesome because they're paying a 3% dividend, but it's super, super well covered. We're talking it's at a 29% payout ratio. So these guys have nothing to fear when it comes to the dividend. So basically the story here on these guys, you're watching that same story play out with Tourmaline with the natural gas prices way too low now. It's going to go higher. They got a couple other businesses that I think are really interesting, like the condensates business that's giving them this like stable baseline of cash flow that's going to help them pay out that dividend. And then you just have gravy on top because they're so cheap that the slingshot effect of them being so low and then shooting upwards is going to be even more dramatic than some of the bigger players. And I'm willing to take a little bit more risk on their size, right? Risk that they might get bought, risk that there might be some like shorter term or specific operational challenges in order for that longer term return. It's not going to be a giant position for me. I'm not going to build it as big as CNQ, but I think these guys have one of the best return profiles over the next year or two. And I think it could be, again, like a double or triple up in a short amount of time and just shock investors, right? I think you're going to see way more people bullish on this stock at the end of 26 than you do right now because it will have already started to move by then. And then it'll look smart for them to be saying, I'm bullish on ARC instead of right now when you see it dropping and it sounds silly. Fourth on the list today is Enbridge. Now, these guys are a little bit of a different play for me because it's not necessarily a producer of oil and gas, but instead it's all about transmission. It's about power. I think Enbridge plays a really interesting role in this space because they have so many opportunities for growth in Canada that they also can just massively change the way the company is running within a moment's notice based on the opportunities that are presented to them and what actually happens and all these things. And they're already such an awesome company because these guys are basically the king of consistent high dividends. They pay out a huge amount. It's like a giant utility company. It's great. But think about the potential growth opportunities here, right? Think about the AI growth. These guys are the #1 natural gas utility in North America. Think about the demand for AI, the demand for natural gas. Enbridge is going to be there. Think about the demand for renewables, not in the next 5 years, but in the 5 years after that, right? As money flows from one sector to another sector, and all of a sudden you see this huge boost, Enbridge is going to be there for that. Think about the demand for nuclear and transmission and all. Enbridge is going to be there along the way every time we see this energy demand grow. And energy demand is growing meaningfully for the first time in most people's memories, right? Since deindustrialization back in the day, this is the first major growth in electricity demand in North America. On top of that, it's at a time when all these LNG facilities are getting built. So natural gas transmission is just going through the roof. It's at a time where there's these pipeline potentials being built, right? We got actual like crude oil pipelines, a lot of them in the States, very few in Canada, but maybe that are being built. So there's so much opportunity for Enbridge here. And the best part is they are basically a utility company underneath all that growth. So even if the stock doesn't grow at all, they have the ability to grow their revenues, to pay out their dividends for decades. So you're getting a really safe, consistent dividend with just gravy growth on top, which I think is so interesting. If I show you a couple of key stats here, you'll understand a little bit better. These guys are by far the biggest company we're talking about today, 150 billion Canadian dollar market cap. They're also the most expensive at a 24 PE, but you're paying up for quality. You're paying up for that moat that they have around them of being this scale player that has all of these different utilities, right? They're in all these spaces as a regulated utility. They're in all these spaces as a, oil liquids pipeline. They're in all these spaces as a natural gas pipeline. There's all these different stories going on there. Of course, the dividend is what most people invest in them for, including myself. And we're looking at a 5.7% dividend yield. And you might be looking at that payout ratio and thinking, man, unsustainable. And a lot of people have actually had that sort of same question, but I don't think you have to stress too much about that because we're also in a rate cut environment, which is going to be huge for companies like Enbridge who have a bunch of debt that they take on in order to finance growth. And because of that, I think the next 10 years are going to see them grow their portfolio with a cheaper debt price. You're going to see that payout ratio drop back below. And again, They have all these interesting growth opportunities with the world of AI, electrification, even the growth of North American oil and gas infrastructure, right? There's all these stories going on for them. And I think that if you count them out, you're going to miss out on a bunch of profit because they're just going to pay you a great total return thanks to that huge dividend. And it's going to be a great long-term payer, which for a lot of portfolios is something you need to search for because a lot of other dividend stocks just don't have that same long-term appeal. My last stock today, the first small cap I'm bringing to the channel here is Surge Energy. Now, these guys have such an interesting opportunity here, mainly thanks to size. If you look at the company here, they're basically another Canadian oil and gas E&P company, right? They're a smaller scale player, which means maybe they don't have the same protection against the downside. Maybe they don't have the same ability to just outlast everybody. Maybe they can't survive a brutal oil and gas winter here in Canada or another, decade of no growth in the industry and serious regulation. But what all of those questions have meant is that this stock is priced so cheap. These shares, the guys, like, look at this. This is a $6 stock. We're talking about a tiny dividend. These shares are so under the radar that most major investors have no concept of what this company does or what it should be worth. And what that means is you've got a company that's trading under $1 billion in market cap, that while it has a PE ratio of 13, thanks in part to some of the challenges with the short-term price, it also has a tiny float, giant profit margins, even at these depressed prices. It pays out a 7% dividend yield, which is well covered, right? It's within a reasonable payout ratio in a tough environment. So it's going to pay you out a huge amount of money to hold. It is an incredibly cheap stock in the grand scheme of things. They hold some really interesting assets in areas that are likely to see more growth in the next couple of years. And it's a buyout target because it's a super cheap company that is likely to see some sort of massive jump as somebody tries to buy them out within the next couple of years as American money starts looking for more conventional oil assets up here in Canada. So I'm talking about really cheap. Nobody knows what the assets are priced. Buyout target. We've seen this story play out a couple times, and almost every single time you're looking at a 30-40% boost from the current stock price because those American investors coming in understand what the assets are worth better than the cash flow show or the investor presentation show, or that investors here in Canada are willing to pay. And when you see those bumps happen, you get huge profitability. And if I'm wrong and they don't get bought out and nobody's interested in buying them, well, I'm going to get a 7% dividend that's well covered in an environment where the oil price is going to improve in the long run, and these guys are going to be able to sit on their roses. So those are my 5 companies today. Each of them offers you a very different look at the Canadian oil and gas space, but all of them offer you the same opportunity to take advantage of the market being wrong, of the market not understanding the opportunity here in Canada, of not seeing that Canadian oil and gas assets are underpriced, companies are underpriced, and these stocks are too cheap. They're giving them away for free, basically. So that's what I'm buying right now. Let me know what your thoughts are down below. Obviously, there's a couple names that are big players that I didn't mention, right? I tried to get a interesting mix here, and they're all companies that I am buying right now. And so if you have another name that you think I should mention or you want to see a deep dive into, please do drop that in the comments below. And if there's another sector that you think offers a similar opportunity, underpricing, the market's counting it out, also mention that because I'm interested in seeing what the next opportunity might be once 2026 gets here and we start making a huge amount of money from these oil and gas plays. That being said, hope you enjoyed the video. If you like what we do here on the channel, please do like the video. If you like covering these Canadian topics, please do subscribe. And I hope I see you in the next one.